Well, we're celebrating 30 years of Squawk Box this week. This morning, we're also reflecting on September 11th. Our next guest was in Lower Manhattan on that fateful morning. Joining us right now is former Goldman Sachs CEO Lloyd Blankfein. This is quite a morning because there's a lot of things that we were talking about. Charlie Kirk, 9/11.
No, it's kind of, I don't want the whole conversation to be so sober, but it's a sober moment to reflect on. And of course, I was downtown all day, worked downtown, and every night on TV, these lawyers run these ads for people who got diseases from breathing in that stuff. Of course, I had lymphoma, so I always get reminded when I watch late night TV of the consequences of working alongside the World Trade Center that day and for months afterwards.
I didn't connect those two. Yes, you did. And you're better than ever. But I remember, and you can't say for sure, but why wouldn't you at least think there's some linkage there?
Well, people who weren't downtown get it, and people who were downtown don't get it, so you never know. But it's an environmental thing, and so every time I see one of those ads for people to join some class action or something, I don't do it, but I think about the consequences of that day.
What do you think about it on a morning like this? Meaning, we're 24 years later, and to the extent that there's generations of people who may not even understand it or know it, what took place that day? I think of circle of life, Simba. Life goes on, and people were too young to remember it. And I was born, after World. People were in World War II. Did I live through World War II? The other day I was talking to somebody, and they were reflecting, and they said that their nephew didn't know enough about Vietnam. And I said, well, he was born further from Vietnam than you were from World War I. And so it's just the nature of things. And, it's good. It's part of the charm of life. You don't get too overly saddled with the consequence, with things that just came from the past. And we can look forward, as we're going to do this morning. Okay, so let's do that right now,
yes.
Which is, I always think of you as someone who thinks about risk, as a risk manager. So where are we today in America in terms of our economy, in terms of all of the different cross currents? We got tariffs, we've got issues about the Federal Reserve and what they're going to do or not do. We've got questions about the independence.
Yes,
geopolitics.
We certainly have a wall.
What does the risk manager that is Lloyd Blankfein say about all this?
We have a wall of worry, and look, we're about to lower interest rates into a bull market. So I would say the setup for the markets is pretty benign, and we can go over a lot of details, but everybody else, talks about that. And then you have to worry about a lot of things that could go wrong, which, I always lived life, spent 99% in the 1% of the things that could go wrong, so explains a lot of my unhappiness all the time. But the way but people are hard pressed to come up with it. People don't see a lot of leverage, and they don't see this and they don't see that. The way I used to try to draw people out is I never used to say what could go wrong. I'd say, you just, you were swimming in the Arctic, you got frozen in an ice floe, you melted down, and a year later, I'm telling you the market crashed. Tell me what happened. And then people could come out and say the likeliest things that probably could have happened. And it usually involves around leverage in this time now, probably credit, leverage in places that you don't see it, and there's certain environmental hazards that are here, and then I used to think to myself, if I could think of it, that's probably the last thing that would happen. But I look at credit spreads being so narrow, so much money going to private credit, people trying to, goose their returns a little bit by leveraging up in kind of odd ways, at the portfolio level or other levels.
Right.
And so, leverage starts to think in. I think of the places where this is being done. A lot of these assets are being put into insurance companies where people are people kind of assured because the long term, they're investing premia for longer term liabilities. But if I were an insurance regulator at some point, I might say, are those assets really worth what you say they're worth? And are they going to come? Is it going to come to pass that you'll have the money to pay your liabilities? And let's look at that and let's mark them and let's take. There are a lot of things like that I would be going out and, we'd going around the table, and then somebody would say, well, I don't think this or that. And I'd say, well, I don't care what you think. Just tell me what might happen.
But do you say to yourself, though, these are sort of 1% risks, and otherwise, as you said, we're in this benign environment, which I think you're saying is a bullish environment and continues apace? Or do you say
there's a lot of
there's a lot of 1% risk, but it's not a 1% risk that something bad will happen. It always look. We had, the crisis of the century roughly every 4 or 5 years. The debt crisis, emerging debt crisis in 1994, big crisis 1998, long-term capital and the Russia debt default, dot-com bubble, 2000, 2001, 2007.
We're quick learners?
We're kind of, well...
Or are you saying we're due?
I'm saying we're due. And it doesn't matter that you can't see from where it's coming from. Now, having said that, the other thing I used to ask people all the time is, it's so, you sound so much smarter when you're bearish. Then I used to say, what do you think? And then I said, what are you? How are you positioned? And, I have all these bearish thoughts, but I'm 100% in equities.
Personally, right now, you are.
Yeah, because because we're about to lower interest rates into a bull market. Anything having to do, there's anything having, people who can't spell AI, but will buy anything that's associated with it. People think it's it's an epic moment.
And do you think it's an epic moment? Is the trader that is Lloyd Blankfein buying all of the mag set? Like, when you say you're 100% in equities, what does the portfolio look like?
I think it's a phenomenal moment. It might be. I'm not a great technologist, and I've lived through waves of technology, and I experienced things that changed the world, and I experienced things that changed our fortunes because we overinvested in stuff.
Lloyd, have you ever not been 100% in equities? Was there ever a time where you thought, okay, this is getting scary, I'm going to take some money?
And let me ask the corollary to that, because we go back a ways and we've been in different forums. We've listened to you and off-the-record things in foreign countries, that have a lot of skiers and stuff that we cannot talk about. But we've talked. You have always had a lot of things that concerned you, and you say it's 1%, and you're a risk guy. I just want to know, and answer Becky's question too. On a scale 1 to 10, you're always worried about all these things. Is it more or less right now than normal? Because that's the only way as a risk guy. And you've always been able to stay 100% invested, even though you're always.
Well, listen, we had you divide the world into your outlook in 2 parts. What do you think is going to happen? What do you bet on? How do you position yourself? And then you get into risk management mode, where I don't care what anybody thinks. Just what could possibly go wrong? Let's look around the corners.
That's when you're managing for a firm.
Right. Well, I think about that.
Versus what you're doing for your personal.
The answer is, I think the world is, I think the investing market is all tailwind, except it can't possibly be. So I have to work. I have to work to find. I work to find things. But that's the nature of my. That's the nature of my life.
I think when you were managing other people's money, you were probably more cautious with it than potentially your own. I'm just guessing. Or is there a time where you were ever not 100% involved in equities?
Oh, sure.
Yeah. There was a time when you took money off the table.
But I don't know. I don't know if it correlated with what the reality. I used to. I'd say to people, if people looked, very happy and the world was benign, I'd say to people, I haven't felt this good since 2007. Or I haven't felt this good since early 1994. I thought the birds were chirping and the sun was shining in those periods of time, and who knew?
But I guess that's what I would ask. Is there a time that you've ever taken money off the table? And,
yes.
I feel what caused you to do that?
To answer your question, in the risk-taking side of things, I feel very, very good about things, and in fact, but kind of informs my sense of foreboding. That I haven't felt this good since 2007,
right?
Or 1994.
But you don't know when it's going to come, so there's not a whole lot you can do about it.
Well, I think you have to protect the tail risks. I wanted to own lottery tickets, not write them.
Right.
And you start to look at in times like this, I want to go around and I want to see, what's really susceptible. What could go, if something went wrong, what would the impact? And so you can move up the credit curve and you can move up the higher value curve, and I think that's not a bad thing to do now. And it happens to conform to my view of the market because I think the most exciting companies, the fastest growth, usually size is the enemy of growth.
Right.
But here you have the biggest companies who are positioned to take advantage of the new technologies because they can afford to, have been the best ones to go in. But then you go and other people are coming to the market today with companies that are the next level down, the next level down, next level down, and those are riskier.